All right, so let's jump into some really cool ways you can actually put your crypto to work for you. We're going way beyond just holding it, or as everyone in crypto likes to say, hodling.
Yeah, hodling.
I always loved that term, originated from a typo on a Bitcoin forum way back in 2013.
A classic.
Yeah, it really shows you about holding strong even when the market's going up or down. But today, we're going to be exploring all sorts of methods where you can generate some passive income with those digital assets.
Absolutely. We're going to be taking a deep dive into all kinds of different options, from staking to things like yield farming and providing liquidity.
Okay, let's start with staking.
Yep.
I know this is something that's become really popular, especially with Ethereum shifting to a proof of stake system.
Yeah.
Can you explain, maybe for those who aren't familiar, how proof of stake differs from proof of work, and then how does staking actually work?
Sure. So think of those older blockchains, like Bitcoin, which use proof of work kind of like a giant competition. It's very energy intensive. Miners have to use all these computers, tons of processing power to solve these complex problems.
Like a digital gold rush, but with computing power instead of pickaxes.
Yeah, that's a great way to put it. So proof of stake, or POS, it's a whole different approach. Instead of miners, now you have these validators. They're the ones who lock up or stake a certain amount of crypto. And this acts as collateral and gives them a chance to be selected to verify those transactions and add blocks to the chain.
So it's almost like you're putting your crypto to work, right? Instead of just having it sit idle,
Hmm.
what kind of rewards can you get for doing this work, basically?
Well, the rewards vary depending on the network and how much you stake. But it usually comes from a few sources. You've got your inflation rewards, which are new tokens given out to validators. Then you've got block rewards, which go to the validator that adds a new block to the blockchain. And then, of course, there are transaction fees. A portion of those will go to the validators, too, for processing the transactions.
Okay, so a mix of kind of newly made tokens and the fees from the network. It sounds like a pretty decent way to earn passively. I imagine Ethereum, since it's one of the largest POS chains, is probably a good example of the kind of returns you can expect, right?
Yeah, definitely. Right now, Ethereum staking yields something like 3 to 4% per year. But keep in mind, there are other blockchains out there like Solana or Avalanche that can have even higher yields.
Wow, those are pretty tempting numbers, especially these days when, interest rates are low. But I'm assuming there's got to be some downsides, or at least some risks that we need to think about.
Of course, of course. There's always risks. One of the biggest ones is called slashing. If a validator, tries to cheat, do something malicious like double spend tokens, or if they go offline for a long time, they can get penalized and part of their stake gets taken away.
Yikes. That sounds like, you could lose a chunk of your savings just for misbehaving.
Yeah.
Are there any other things we should watch out for when it comes to staking?
Yeah, definitely. So another thing is something called liquidity risk. When you stake, your tokens are usually locked up for a certain period. This could be a few days, a few weeks, even longer sometimes. So this means if the market takes a sudden dip and you want to sell, well, you might not be able to access your funds right away.
Right, you're kind of stuck.
Exactly.
And I guess on top of all that, there's still the inherent volatility of the crypto market, right?
Yeah, you always have to consider that. Even if you're earning those staking rewards, the price of the crypto you're staking, it could drop. So you have to keep that in mind when you're calculating your returns.
Makes sense. So choose carefully both the platform you're using and the cryptocurrency itself. Now, I've heard there are ways to stake without having to run a node yourself.
Oh, absolutely. There's something called staking as a service, sometimes called SaaS for short. This is a great way to make staking easier for people who, aren't super technical,
Yeah,
or maybe they just don't want to mess with running a node themselves.
makes sense.
So some good examples of platforms that offer this are Lido and Rocket Pool, both on Ethereum. You basically delegate your tokens to them, and they'll take care of all that staking stuff for you. They'll take a little cut for their services, though.
So it's almost like having a professional, gardener tend to your digital garden and making sure your crypto is growing and blooming with those nice staking rewards.
Yeah, that's a good way to think about it. But of course, anytime you're entrusting your assets to a third party, you need to be careful. You want to make sure you choose a SaaS provider that's got a good reputation, a history of being secure and reliable.
Yeah, that's solid advice. So staking, it seems like a great way to put your crypto to work, but it's really important to do your research and understand all the risks involved.
Absolutely.
Okay, well, let's move on to another popular method for earning crypto, and this one is called yield farming. Now, this sounds a bit like, digital agriculture to me. Instead of growing crops, you're growing, crypto crops.
Yeah, the name's actually pretty fitting. Yield farming, it's all about cultivating those returns within the DeFi ecosystem, which is decentralized finance. You're basically lending your crypto to these DeFi protocols. And that helps them do all sorts of financial activities like trading and lending and borrowing.
So instead of relying on traditional banks, you're becoming part of this whole decentralized financial system, and you're earning rewards for providing that liquidity. It sounds really, in line with the ethos of cryptocurrency.
Absolutely.
But can you break down a little bit more how this yield farming actually works? What does it actually look like in practice?
Sure. So let's say you have a decentralized exchange like Uniswap or PancakeSwap, which is popular on those EVM compatible chains. They need these things called liquidity pools to make trading possible. These pools are basically big collections of different cryptocurrencies that users can trade or swap. When you do yield farming, you're putting your crypto into these pools and you become a liquidity provider.
Okay, so you're contributing to this big pool of cryptocurrency that powers these exchanges. But how does that actually translate into you making money?
Well, you get these things called LP tokens, which show how much of the pool you own. And these tokens often come with extra benefits, like maybe voting rights and how the protocol is run. And as trading happens in that pool, you earn a portion of the fees that are generated from those trades. And that's paid out in the form of even more tokens.
Interesting. So the more people trade in that pool, the more you could potentially earn. But I have to imagine with higher potential rewards, the risks must also go up, right? With yield farming.
You're absolutely right. One of the biggest challenges, and probably the most talked about risk with yield farming, is something called impermanent loss. Let's say you contribute to a liquidity pool that has two tokens in it, token A and token B. And the prices of those tokens, they're always moving up and down, right? So
Mhm.
if the price of one token changes a lot compared to the other, you might end up with less of one and more of the other when you decide to take your liquidity back out of the pool.
Okay.
And what can happen is that can result in you having less overall value than if you had just held those tokens separately.
It's called impermanent because you only really realize the loss when you actually take your tokens out. That
Yeah.
that does sound like a tricky thing to manage.
Yeah.
Are there other risks with yield farming that people should be aware of?
Oh, there are definitely other risks. There's always the chance of bugs in the smart contracts or even hacks. DeFi protocols, they're fairly new. And sometimes, there are vulnerabilities that hackers can exploit. And then there's also the volatility of the tokens you earn as rewards. Those prices, they can go up and down a lot, which adds another layer of risk to the whole thing.
So yield farming, it sounds like it offers a lot of potential for big returns, but it also requires, a lot more knowledge and understanding of the risks
Yeah.
compared to something like staking.
Yeah, I think that's a fair assessment.
Okay. Now, before we move on, I think there's an important distinction to make when it comes to yield farming and the types of platforms that are involved. We've been talking about automated market makers or AMMs like Uniswap, but there's also this other type of exchange called a central limit order book or a CLO.
Right, right.
So how do they play into yield farming, and what are the differences in the risks involved?
Well, the main difference has to do with how that impermanent loss we talked about actually happens. With AMMs, that loss can happen anytime those token prices in the pool start to move apart. But with a CLOB, you generally only run into that impermanent loss if the price of the token that you're providing liquidity for, if that price moves significantly in the wrong direction while your limit order is still open.
So basically, the kind of risks you face depend on the type of exchange you're using for that yield farming.
Mhm.
It sounds like it's crucial to really understand how both AM and CLOs work before you jump into, doing any yield farming.
Absolutely, yeah. You got to choose the right platform and strategy for your own risk tolerance and your investment goals. You can't just jump into anything.
Okay, excellent point. Now let's switch gears a little bit and talk about another method you mentioned in the materials, which is crypto lending. Now this sounds a little bit more familiar, at least in concept, than some of these other DeFi strategies we've been discussing.
Yeah, it is in a way. You can think of platforms like Of and Compound as kind of the crypto versions of banks. They connect people who want to borrow with people who want to lend, and it allows individuals to lend their crypto and earn interest, just like you would with a traditional savings account.
Okay, so it sounds straightforward enough, but in crypto where anonymity is so important, how do these platforms actually make sure that the borrowers repay their loans?
Well, that's where something called collateralization comes in. Borrowers have to put up collateral, usually in the form of, another cryptocurrency. And that collateral, it's worth more than the amount they're borrowing.
Okay.
So that acts as a safety net for the lender. So if the borrower can't pay back the loan, then the platform can just sell that collateral to make up the difference.
It's almost like a digital pawn shop where the collateral is your crypto. What happens if the value of that collateral suddenly drops, like, because the market's so volatile?
Yeah, that's one of the big risks with this type of lending. If the value of the collateral falls too far, it can trigger what's called a liquidation. So basically the collateral is automatically sold off to repay the loan.
Hmm. So even though crypto lending seems kind of, simpler than yield farming, it still has those risks that are tied to how much the crypto market can move up and down. Are there any other things that lenders should be cautious about?
Yeah, there are a few things. Smart contracts, there's always the risk that there's a bug in the code, a vulnerability.
Right.
And then there's something called oracle risk. So oracles, they're like these external data feeds that give price information to these DeFi protocols.
Okay.
And if an oracle messes up or if it gives bad data, well, that can throw off the whole lending process and maybe even cause losses.
So it sounds like you really have to be on your toes no matter what kind of crypto earning strategy you choose. There's always, things to be aware of. Before we jump into some of the more advanced ways to generate passive income, let's take a quick detour and talk about something that sounds, well, honestly, a bit more like treasure hunting. And that is airdrop farming.
Yeah, airdrops. They're an interesting part of the crypto world, that's for sure. You can think of them like little gifts of free crypto tokens, new projects, give them out to attract users and, get people excited about their project.
Like a little welcome gift just for being part of the crypto community.
Yeah, exactly.
I'm guessing it's not quite as easy as just signing up and getting free tokens, though.
Yeah.
What does airdrop farming actually involve?
Yeah, so a lot of times it means you have to be pretty active, really engage with new platforms. Some common things they ask you to do are like bridging assets between different blockchains or providing liquidity on decentralized exchanges or maybe participating in their governance votes.
Yeah.
You're basically showing them that you're committed to their project.
You're invested.
Yeah, you're helping it grow, and in return, you might get those airdrop tokens.
So it does sound like a bit of a scavenger hunt, right?
Yeah.
Got to keep your eyes peeled for new promising projects, figure out what their rules are for getting those airdrops. But I imagine there are risks involved with airdrops too, right?
Oh, yeah, of course. Not all airdrops are created equal.
Right.
Some are scams, basically designed to try to steal your crypto or your personal information.
Oh, wow.
So you always have to research any project very carefully before you participate. Make sure it's legit.
Yeah.
And that they have a clear plan for what they're building.
So airdrop farming can be a good way to, add some more variety to your crypto portfolio, but you have to be careful, do your homework. It's not just about, chasing after free tokens.
Exactly. It's more about finding good projects that you believe in and that you want to help succeed.
Okay. Excellent point. So we've covered a lot today. Staking, yield farming, even airdrop farming. Before we jump into some of those more advanced methods for earning crypto without selling it, let's take a short break. When we come back, we'll be diving into things like basis trading, crypto index funds, and tokenized debt instruments. Stay tuned. Welcome back.
So we've talked about some great methods to maybe, boost your crypto returns. But now let's get into some stuff that's maybe a little more, well, adventurous.
Yeah, these next strategies, they're definitely for folks who have a good grasp of the crypto markets and aren't afraid of a little more risk. Okay, I like a little adventure. So let's start with this idea of basis trading. You mentioned this earlier. It sounds like something you'd hear on Wall Street, not really, in the world of crypto, which can be pretty wild sometimes.
True. It might sound a little complicated, but the concept is actually pretty smart. Imagine you're really bullish on Bitcoin. You think it's going to go up.
Right.
But you don't want to sell what you already have just yet.
Yeah.
So with basis trading, you can actually profit from that bullish feeling, that belief that it's going to go up, but you get to hold on to your Bitcoin at the same time.
I'm listening. I'm intrigued. How does that actually work? How do you pull that off?
So it involves a combination of hodling, which we talked about before, and shorting something called cryptocurrency derivatives.
Okay.
Now, I know that word derivatives can sound a little scary, but just think of them as contracts that get their value from something else, like in this case, Bitcoin.
So you're kind of making a bet on the price of Bitcoin, but without actually buying or selling the actual Bitcoin itself.
Exactly, exactly. So with basis trading, what you would do is you would lend out your Bitcoin, on a platform and you earn interest on it, similar to staking. But at the same time, you open what's called a short position on a Bitcoin futures contract.
Wait, hold on a sec. What does it mean to short a futures contract?
Okay, shorting, it basically means you're betting that the price of something is going to go down.
Oh,
In this case, you're hoping that the price of that Bitcoin futures contract will drop, but you're still holding on to your actual Bitcoin and earning that interest, remember?
so you're making money potentially from the interest on your Bitcoin, and then also from the price difference if your bet on that futures contract goes the way you want it to.
Exactly. You got it. Now, the real key to basis trading, it comes down to something called funding rates.
Right.
So in futures markets, the price of those futures contracts, it can sometimes get out of whack with the actual price of Bitcoin, the spot price.
Okay.
So to keep things in check, exchanges use these things called funding rates.
So it's like a way to make sure that futures price is kind of reflecting the real value of Bitcoin out there in the market.
Right, exactly. Now, let's say there are more traders who think Bitcoin's price is going up, we call those long traders, than those betting it'll go down, the short traders.
Yeah.
If that happens, that futures price might go higher than the actual spot price. So to balance things out, the exchange, it basically encourages the short traders by having those long traders pay them a fee. And that fee, that's the funding rate.
Interesting. So in a market where everyone's really optimistic, bullish, thinking Bitcoin's going to the moon, you as a short trader, you could be earning those funding rate payments while still holding your Bitcoin and getting that interest.
Exactly, yeah. That's the cool part about basis trading. You're making money from two sources, the interest from lending out your Bitcoin, and those funding payments from all those bullish long traders.
Sounds pretty clever, gotta admit. You're kind of, taking advantage of that bullish market sentiment without actually having to sell your Bitcoin. But there's got to be some risks, right? It can't all be sunshine and roses.
Oh, absolutely. There are risks. Basis trading, it can definitely make you some money, but it's not for beginners. Those funding rates, they can change, they can fluctuate, and managing both your, hodling position and your short position at the same time, that takes some real skill and a good understanding of how derivatives work.
So maybe basis trading is more for the experienced crypto traders, not necessarily for folks who are just getting started. Now, what about these crypto index funds? I've heard that term thrown around a lot lately. Are they similar to like the index funds you see in the stock market?
Yeah, they are. They're very similar. The idea behind crypto index funds is that they give you this diversified exposure to the whole crypto market. So instead of trying to pick individual winners and losers, which is tough even for experienced investors, you can put your money in a basket of cryptocurrencies, spreading your risk around.
So it's like you're not trying to time the market or bet on specific coins. You're just saying, hey, I believe in the overall growth of the crypto market, and you're going along for the ride.
Yeah, that's it. And just like with traditional index funds, the idea is to hold for the long term, ride out all the ups and downs and aim for that long-term growth.
So are all crypto index funds kind of the same? Are there different types of indexes to choose from?
That's a good question. There are actually all sorts of crypto indexes, and they each have their own way of picking the cryptocurrencies that go in them. Some indexes might just track the top 10 cryptocurrencies by market cap, while others might focus on specific parts of the crypto world, like DeFi or gaming.
So you got to pick an index that matches your investment goals and how you feel about different sectors of the market.
Exactly.
What about returns? Like how do they compare to, say, staking or yield farming?
Well, the returns can change a lot. It depends on the specific index and what the market is doing overall.
Right.
But one nice thing about index funds is that they give you that exposure to a whole bunch of different cryptocurrencies. And that can help reduce your losses if the market takes a downturn.
That makes sense. You're spreading the risk around.
Right. Plus, some crypto index funds even offer extra returns through staking rewards.
Oh, wow. So it's like a double win. You get potential growth from the cryptocurrencies in the index, and then you get those staking rewards on top of that. Are there any specific platforms or companies that you'd recommend for people who want to learn more about crypto index funds?
There are more and more platforms popping up all the time that offer these types of funds. I'd say the most important thing is to do your homework, find a provider with a good reputation, make sure their fees are clear and transparent, and that they have a strong security system in place.
That's good advice.
Hmm.
Okay, before we wrap up this section on, these more advanced crypto earning strategies, let's talk about tokenized debt instruments, or what most people call crypto bonds.
Crypto bonds, they're pretty interesting. They offer this way to get a fixed return in the world of crypto, which, as we've been talking about, can be very unpredictable. Basically, they're digital versions of traditional bonds.
So instead of lending your money to, a government or a company, you're lending it to a crypto project or platform.
Exactly. And in exchange for lending your crypto, they pay you interest regularly, just like a traditional bond, over a set period of time.
So you're like a digital lender supporting these projects while getting a pretty predictable return. That sounds appealing, especially for people who are, maybe a little more risk averse.
It can be, but like with anything, there are risks involved. It's really important to check out whoever is issuing that crypto bond, see what their track record is like, and really understand all the details of the bond before you invest.
So due diligence, really important,
Oh,
just like with any other investment in this space.
couldn't agree more. And, before we move on, I think it's crucial to remember that while these fancy strategies can offer bigger returns, they're also more complex and riskier.
Absolutely. Don't jump into something you don't fully understand.
Right.
Know your own risk tolerance, know what your goals are.
And if any of these things we've been talking about seem overwhelming or confusing, don't be afraid to do some more research, read up on it, or even talk to a financial advisor who understands crypto.
Great advice. So today we've gone from, the basics of staking all the way to basis trading and crypto bonds. Pretty amazing stuff. Before we wrap up our whole deep dive into earning crypto without selling it, we need to talk about something that's really important, but a lot of people overlook: taxes. So stick around as we figure out how to navigate the sometimes confusing world of crypto taxes. Welcome back. So we've gone through a whole bunch of different ways to potentially, really make those crypto holdings work for you, but let's be real. No financial discussion is complete without talking about taxes. And I think in the world of crypto, taxes can feel a little bit like, going through a maze.
Oh, absolutely. I think that's a perfect analogy. The whole crypto space, it's still so new, and the tax
That's
rules are always changing. It's definitely an area where people get confused, even seasoned investors.
So let's try to clear things up a little bit, shed some light on this part of crypto investing that a lot of people just kind of ignore. First things first, are all forms of crypto income taxable, even if
Yeah.
you're not, cashing out, converting it back to regular currency?
In most places, yeah, it is.
Yeah.
Even if you're just earning those staking rewards, those are usually seen as taxable income. Same goes for what you make from, yield farming, lending, even airdrops.
So even if my crypto just sitting there, doing its thing, earning some passive income, the tax man still wants a cut.
Pretty much, yeah. That's the general rule in most countries. Of course, the exact tax laws, the rates, those can be different depending on where you live. So it's always best to talk to a tax professional who really gets, the ins and outs of crypto taxes.
Yeah, that's probably a good idea. So what are some of those like common taxable events that crypto investors should keep in mind?
Well, anytime you get staking rewards or interest from lending, that's considered a taxable event.
Yeah.
Airdrops, those are taxable too. And obviously, when you sell your crypto, you trade it for regular money or even for another cryptocurrency. That's a taxable event as well.
Okay, so basically anything you do with your crypto that makes you money or even just generates some kind of profit could be taxed. Sounds like you really need to be on top of your record keeping, like really meticulous about it.
Oh, for sure. It's super important to track all your crypto transactions, every single one. When you buy, sell, trade, staking rewards, airdrops, the whole nine yards. The good news is there's a lot of great software out there these days that can help you keep track of all that stuff automatically.
So you don't have to, have a giant spreadsheet or something.
Exactly, yeah. Makes things a lot easier.
So it's almost like keeping this detailed diary of your crypto journey,
Right.
writing down every single trade, every little reward you get, every airdrop.
Exactly. You got it. And don't forget about those gas fees.
Ugh, yes, those gas fees.
Yeah, they add up, but you can often deduct those.
Like paying a toll every time you want to move around in the crypto world.
Yeah, kind of, but hey, it's the price you pay. Now, another important thing to remember, tax laws, they can change. So something that's taxable today might not be taxable tomorrow or vice versa.
So you really have to stay informed, keep up with all the latest, tax rules and regulations.
Absolutely. Honestly, having a good tax advisor who knows crypto, that can be invaluable. They can give you advice that's specific to your situation, make sure you're not missing any deductions, and just, help you stay out of trouble with the tax man.
Yeah, that makes sense. Okay, so as we wrap up this whole deep dive into, earning crypto without selling it, what's the big takeaway you want our listeners to walk away with?
I think the most important thing is to remember that while there are all these incredible opportunities to make passive income with crypto, you have to be smart about it. Don't get carried away.
Okay. What do you mean by that?
It's easy to see those huge potential returns and just go all in, but you got to remember, crypto, it's still a young market and it's volatile.
So don't put all your eggs in one basket. Spread your risk around, manage it carefully.
Exactly. You got it. Really understand the risks that come with each of those earning strategies we talked about. Do your research and never, ever invest more than you can afford to lose. And of course, never forget about those taxes.
Great advice. So as we kind of move forward in this exciting, ever-changing world of crypto, let's all be informed, strategic, and responsible investors.
Yeah, absolutely. I couldn't agree more.
Well, that brings us to the end of our deep dive today. We've gone from, the basics of staking all the way to the complexities of basis trading and, of course, those ever-important tax considerations.
It's been a great discussion. I really enjoyed it.
A huge thank you to our expert for walking us through all this complex stuff. And to our listeners, don't forget to check out all the resources we mentioned in the show notes. Keep learning and exploring in the world of crypto. It's an amazing space.
And happy hodling, everyone.
Until next time, stay curious. And may your crypto journey be both profitable and, of course, tax compliant.